be able to showcase the business to you in such a level of detail, and I thank my fellow presenters for the insight that they provided today. I think you'll agree with me that over this morning's presentations, we've been able to outline the unique capabilities that Farfetch as the platform for the global industry has developed. That rich insight that all of our leaders across the three pillars provides confidence about the business potential moving forward. I think you'll agree with me as well that presents us a significant opportunity from the numbers that we have been delivering over the last 12 months. And this is a real tipping point for Farfetch as we are now set to see the business start to accelerate its growth and deliver a second phase of growth moving forward. Importantly, that growth this time comes with significant profitability and free cash flow. This is because we have invested heavily in the business to date, and these business investments are starting to pay off and are set to accelerate that return of investment moving forward. The future is very strong for Farfetch, and I want to break that out for you today in very granular level of information so that you can also see how we've built up our confidence around the numbers moving forward. I want to break it out building block by building block, division by division, so that you can see how our 2025 medium-term targets have been established, and then I also want to touch on where we see our longer-term opportunity moving forward. Before I do that forward-looking view, I just want to look back over the last several years, and the key takeaway from our results since 2015 is that Farfetch delivers on its financial objectives. We've delivered 10x our GMV position to 2021. Our revenue has grown 20 times over the same time period. We've scaled our investments and brought down our operating costs by half over the same time period. And we've achieved on our path to profitability, delivering EBITDA positive results in 2021. Importantly, we also achieved positive free cash flow in 2020, and I'll come back to that in a minute. We're now operating at scale. In 2022, we expect to achieve $4 billion in GMV. We'll continue to grow revenue despite the current macro environment to achieve $2 billion in adjusted revenue. Our gross margins are solid at 50% and have been increasing year on year across all parts of the business. And our order contribution on the digital platform is firmly above 30%. Whilst these results are impressive, the best is yet to come. This is because our phase of growth moving forward, as I said earlier on, is not just about driving GMV growth, but delivering sustainable profitability and positive free cash flows. Today, we're establishing medium-term targets. The Capital Markets Day provides us with a unique opportunity to rethink about the business, reset our expectations, and retool our focus towards profitability and cash flow. So by 2025, we've decided we want to focus on achieving two targets, $10 billion in GMV and at least 10% EBITDA margin on an adjusted basis. We have clear line of sight to these targets. These estimates have been built up based on what we know today in terms of signed contracts across the luxury industry that Davide and Kelly talked about earlier on. We're focusing in on the key drivers of profitable growth, using the infrastructure we already have in place to drive significant payback. And we've been cautious about our forward forecasts in terms of the external macro environment, reflecting more on an underlying growth rate that's slower than we have seen in the past, but is reflecting the macro situation that we expect over the next couple of years. I think also importantly, we've not built any assumptions around the pipeline that Kelly talked about, which presents significant further upside. We've decided to focus our forecast on what we have current visibility and a clear line of sight that we're working on. So I'm sure you'll agree that the targets are extremely robust. The first step, though, in delivering $10 billion in GMV and 10% adjusted EBITDA profitability is returning to growth in 2023 and returning to positive adjusted EBITDA. There's three drivers to our guidance for 2023. The first is a 10% reduction in terms of our operating cost base. This is the continuation and the impact of our cost rationalization plans that have started to take effect. As the team has been discussing, simply retooling the business more towards creating value from our customer base as opposed to driving significant growth allows us to focus more towards driving order contribution margins and adjusted EBITDA. The second is allowing our organic growth to reflect the market overall. We're estimating that next year, the online luxury market will grow 8 to 10%. This is matching external predictions that are currently in place. So let's focus on that for next year as we start to adjust how we're going to drive the value from our existing customer base rather than necessarily chasing growth in customers that are actually at low margins and low value. And then lastly, simply incorporating the GMV that we will deliver for our partners on FPS and the brand platform. Again, I want to reiterate, this is just our signed contracts that we're currently working to develop in terms of rollout. There's no pipeline expectations built in, and this therefore is a $500 million GMV position across the business. It's important that you'll see there from the impact on our adjusted EBITDA margins that these initiatives and projects are profitable in year one despite the fact that, particularly within Reebok, we will have to put some investment into the infrastructure on a P&L basis, particularly around logistics, in terms of warehousing, in terms of understanding the customer base, in terms of gross margins, and in terms of building out the team needed to drive further expansion of the categories that David A. talked about before. So for Reebok, we're expecting medium single-digit EBITDA margins from this business in year one, with those margins expanding as the contract matures in the coming 10 years. The result means we will deliver $4.9 billion of GMV at a group level and adjusted EBITDA margins of 1 to 3%. That GMV growth rate ends up being 20 to 22%, 8 to 10% underlying, and the new contract additions taking us above 20%. Importantly, as I said earlier on, retooling the business more towards profitability will see us return to generating operating cost leverage, with our SG&A base set to grow at half the level of our GMV, at 11 or 12%. So we're expecting to deliver 600 basis points improvement on profitability next year. Let's now look ahead at 2025, these medium-term targets that we've set for the business. I'm going to show this by pillar now, rather than by channel that we've been reporting on earlier. And as Alice said at her introduction, we're not committing to report by these new pillars straight away. We'll probably take a little bit longer until the pillars grow to a size where we'll break them out, so certainly by 2025. You'll know how we report today under channel. This is how the customer ultimately shops across the Farfetch platforms, the digital platform with FPS and marketplaces combined, in store, and of course the brand platform, which is wholesale from NGG. Moving forward, we're going to follow the pillar approach. So we'll split out the digital platform between marketplaces and FPS, which means that the brands that the customers will shop for from and our way of delivering in terms of our pillars will be the way we split the P&L from 2025 onwards. All of our 1P and 3P marketplaces under marketplaces, Edward's responsibility. All of our business-to-business technology partnerships that Kelly looks after under the FPS product, and of course everything to do with NGG will sit within the brand platform, in-store, wholesale, and direct-to-consumer. We'll also continue to separate out fulfillment revenue and GMV, because as you know, that has no economic value to Farfetch. So let's look at how we've built up the $10 billion in GMV and 10% EBITDA margin for 2025 across those pillars. Starting with the marketplace. You can see there that we're expecting the marketplaces to grow the GMV of $3.8 billion. This reflects, again, ongoing organic growth rates of around 8 to 10%. Adjusted revenue of $1.7 billion with a 60% gross margin and 40% order contribution margin. The target for our marketplace businesses by 2025 is 5% EBITDA. Platform solutions with the signed contracts that Kelly talked about earlier on is set to grow to over $4 billion in GMV. $300 million of adjusted revenue. The gross margins will remain above 75%, and that means this business will deliver a 20% EBITDA margin by 2025. And the brand platform, again, growing at underlying rates of the market, plus the addition of Reebok will grow to $1.5 billion in revenues and GMV by 2025. This business is set to deliver 20% adjusted EBITDA margins. To complete the picture, fulfillment revenue is likely to come in just shy of $1 billion of GMV and revenue. Whilst that sets the goals for 2025, I think it's important that we should also reflect where we think the business can go in the longer term. Our GMV at a group level will continue to grow above 20% on a compound annual growth rate. And with the combinations of stronger EBITDA margins over the longer term across our three pillars, we would expect the group to continue to target an EBITDA adjusted margin of 30% over the longer term. Let's just focus on those 2025 numbers to show you how we've built them out and why we have confidence in these figures. Looking at each pillar one by one, starting with the brand platform. Again, we've reset our expectations. Let's focus on luxury e-commerce growth as our base, 8 to 10%, and then let's add on the Reebok relationship, which drives inorganic growth for the brand platform from where we are today. The gross margins, by focusing solely on the shift towards direct-to-consumer and starting to grow out the high luxury margin product for Reebok, drives up our gross margin expectations, and the EBITDA margin flows through from scaling of the group infrastructure. So, low levels of growth on an organic basis. By this stage, $600 million from Reebok by 2025, driving $1.5 billion of GMV, 55% gross margin coming through from an increased focus on direct-to-consumer, and 20% EBITDA margins. Remember, the Reebok business by this stage will still be in scale-up stage, so won't be driving the same level of EBITDA margins as we've seen for the New Guards Group brands of the past. Beyond 2025, the partnerships that David A. touched on in terms of finding talent, working with the industry more broadly, will enable us to continue to grow the business over the longer term. And we will continue to scale the platform infrastructure to drive high margin services and a higher EBITDA margin of 30%. Why have we been so focused on direct-to-consumer? Simply because of this on the right-hand side. On the bottom of the right-hand chart, you can see where we capture in terms of margin when we deliver on the wholesale business. Effectively, 25% of the recommended retail price of a product flows through to New Guards Group when the product's sold via wholesale. That's because there's significant 55% retail margin for our retailers within the network. Move that up to direct-to-consumer, either on Farfetch or within NGG stores or on their own websites, and we're able to capture 80% of the ticket price, driving significant gross margins for the business. Our estimate, as you can see on the left, is that by 2025, the business will be at 40% direct-to-consumer, either via online channels or in-store. That's up from the 4% that we started when NGG was acquired. Let's now look at FPS. Again, driving growth by leveraging the infrastructure we already have, holding gross margins flat to where they are now, not necessarily expanding them significantly, and then leveraging our group capabilities to drive adjusted EBITDA margin moving forward. These are the FPS building blocks. We're expecting, again, 7.5%, 8%, maybe 10% organic growth from the existing client roster we have today. But then the new business that Kelly talked about next year into 2024 and then 2025, subject to regulatory approval, drives the business to over $4 billion of GMV. With gross margins not expected to increase, we believe the business will be delivering comfortably 20% adjusted EBITDA margins by 2025. Beyond this level provides a significant opportunity for Farfetch. The large TAM of over $400 billion by this stage and growing beyond provides an opportunity to convert the pipeline of clients that Kelly touched on to drive higher GMV. The take rate can increase as we add additional module services and those value-added products that Kelly touched on in terms of driving luxury growth for our clients. And we will see the EBITDA margins for FPS reach 50% over the longer term by scaling the infrastructure the group has in place. And then finally, our third pillar, marketplaces, that Edward provided such a rich level of insight earlier on. I think the key driver here is focusing on what our unique proposition is to continue to drive high-value new customers and focus on engagement and retention of the existing customer base. In addition, our advertising revenue stream of income will drive high margin levels of revenue coming through, and we will continue to scale the infrastructure we've built across the platform. So here's the P&L by 2025. As I said earlier on, just under $4 billion of GMV, a 5% adjusted EBITDA margin target. I want to actually go through this line by line because I think this is an area that we really need to focus on how we've built up these numbers to provide you with the confidence around what we see happening over the next couple of years. So let's start with our GMV position. And what I'm going to do here is actually break out that marketplace position across our first-party business, effectively Browns and Violet Grey, and then our third-party businesses between our new customer and our existing customer base by 2025. The $3.8 billion effectively will be split between 70% new customers and 30% new customers and 70% existing customers. Existing customers provides the foundation for this GMV forecast. You can see from the historic trends of GMV since 2015 on this chart how the GMV by cohort is solid and growing on a like-for-like basis. Our new customers are also key in driving GMV growth. In particular, over the last couple of years, where you can see we've really accelerated the new customer adoption to 500,000 per quarter, and that's driven a GMV position of just under $1 billion in year out. We're going to hold on to that target of $1 billion for new customer GMV by 2025. We're not going to take that necessarily forward, which allows Edward and his team to focus on driving higher value customers from that new customer mix in terms of driving retention and lifetime value moving forward. Importantly, we're not looking to chase a higher new customer number and a higher GMV from first orders just to let that customer base drop out moving forward. In terms of revenue, fairly straightforward. As you know, our first-party revenue flows through at 100%, and we're expecting to see our take rate on the marketplaces move from 32% of our third-party GMV to 33% by 2025, primarily through contract renegotiations on commissions, but more importantly, that rich opportunity with the advertising revenue that Edward touched on before. In terms of gross margins, we're focusing on improving the first-party gross margin position and getting that back to 40%, which is historical levels for the Browns business and more in line with the overall luxury market. I touched on before how we often give up 55% of gross margins to retailers across the New Guards business, so 40% is a very good position to focus on. We'll be doing this by slowing down our expectations of growth from the first-party business. You can see on the table that we've created for you that it's only going to be delivering $600 million of GMV in 2025, so much slower levels of year-on-year growth from where we've seen historically. We're expecting to see the gross margin on the third-party business improve slightly from 70% that we've delivered over the last few quarters to 72% for 2025, again driven by the advertising revenue income, but also importantly, as Edward touched on, focusing on our ability to drive shipping efficiencies and cost reductions in terms of our cost of revenue. This includes focusing on AOV to drive bigger baskets and reducing our returns rate by better engagement with customers in the first shopping experience. The order contribution targets are to focus on driving our third-party order contribution up through focusing on retained customers and our engagement strategies around demand generation. The table on the left-hand side shows you our GMV in 2021 by different customer cohorts. The 2017 cohort, the most mature on the chart there we provided, driving very strong order contribution across 2021 of 55%. So we have confidence that as we continue to drive our engagement strategies and improve our revenue, we can move that 55% comfortably to 60% and above for our more mature cohorts. And as we drive further retention from our existing customer cohorts through more low-cost strategies that Edward touched on earlier, we'll see the overall blended mix of our existing customers move up to 60% order contribution. New customers, as you would expect, from first order being negative on order contribution, are expected to deliver a minus 15% order contribution margin. Important though, as you can see from the LTV over CAC payback by cohort, we're still seeing payback on a 6-month basis, generally by second order, not first order. And then over time, we're seeing LTV over CACs of more than 3 times on a net cumulative basis of LTV over the original customer acquisition costs. Our expectation is that will improve further as we move forward with our low-cost engagement strategies. So very strong assumptions underpinning our order contribution margin. And then finally, significant operating cost efficiencies to come, whether that's through our technology spend being leveraged across our revenue base, our platform solutions driving up revenue per item at all of our studios, or indeed leveraging our brand marketing and our corporate expenses. So let's just recap across the marketplaces. Until 2025, we're assuming 8 to 10% underlying growth in line with the market, but backed up by well-proven customer trends historically. A higher mix of third-party and improving gross margins on the first-party business will see our gross margins expand. And by focusing on retention strategies that the team have outlined, we will see the order contribution margin expand, particularly on the third-party business. Beyond 2025, we see continued growth from these figures, with the paradigm shift to online that Stephanie outlined being our key driver of success. We would expect to continue to see higher margin revenues coming through by shifting our less than 1% of GMV advertising revenue business closer to benchmarks across the industry. The demand generation expenditure will come down as a percentage of revenue, driving order contribution up through the 8 initiatives that Edward touched on, focusing very much on our millennial customer base and how she engages on the app. And lastly, of course, continuing to scale the fixed cost base. So let's just summarize all the moving parts across the platforms to see how group margins will evolve over the next couple of years. Group order contribution margin, currently around 38%, will move to 46% by 2025. Again, higher margin revenues from FPS, advertising revenue, and lower engagement costs across the marketplaces. Our operating costs will reduce to 34% of adjusted revenue by scaling the investments we've made today, particularly focused on our technology infrastructure, our operations platforms, and corporate functions. And this means we have a steady path to 10% adjusted EBITDA margins for 2025, continuing the success we've had over the last several years of driving profitability for the business. Before we finish, let's just focus on cash, which is a very important measure as we move forward, because we clearly want to see this growth and extra profitability flow through to strong free cash flows. There's 4 key elements to the Farfetch cash operating model. The first is profitable revenue growth, driving significant cash into the business. The second is using the unique dynamics of the marketplace model and our platform solutions model, driving a tailwind in working capital around our creditors. The third is focusing more on third party moving forward versus first party, and within the first party business, making sure we have tight control over our inventory position, including a fast stock turn across New Guards Group. And then finally, low capex. Our technology spend is expected to come down overall to circa 10% of revenues, therefore 5% of revenues in terms of capitalized items. On top of that, some store refits across the New Guards Group portfolio, but we don't have warehouses, we don't have significant infrastructure to build out, so low levels of capex. This model was at work historically. I've shown you here the 2022 free cash flow, which was positive despite the fact that we delivered minus $47 million of adjusted EBITDA. This is because the working capital tailwinds were working properly across that year and driving strong free cash flow. That's our expectation also as we move into 2023, a return to profitability, solving the challenges around our first party inventory, and regrowing the marketplace to drive favourable working capital to cover our capex expenditure and deliver positive free cash flow. In 2025, that will accelerate and we'll see much stronger free cash flows flowing through. Let me finish before I hand back to Jose from where I started. And that is, we deliver. We have delivered on our financial strategy today. This was established at the IPO. We have grown ahead of the online market since then, a 45% compound annual growth rate from 2018 to 2021. We've been maintaining our attractive unit economics across our marketplace business, above 30%. We have delivered leverage across our operating cost base and our investments to date to deliver operating cost efficiencies and higher margins. And we delivered on our profitability in 2021 as targeted. We also delivered positive free cash flow in 2020. So the model works in terms of achieving all of our finance strategy at play. And now today, we have clear visibility that we will deliver not only growth, but sustained profitability and positive free cash flow moving forward. And that's a great moment to hand back over to Jose.